Trading Psychology by Richard Dennis. Mastering Yourself in the Markets. Richard Dennis, a legendary figure in the world of trading, believed that successful trading wasn't solely about intellect or innate talent, but rather a set of learnable principles, particularly those governing our own psychology. His trading psychology encapsulates crucial lessons that separate consistently profitable traders from the rest. Here are 10 essential takeaways from his philosophy. The 10 most important lessons in the book, brought to life with examples. But before we dive into it, please take some few seconds to subscribe and turn on the notification so you won't miss any other video like this again. Ready? Let's get started. Lesson number 1. Trading is teachable. To help understand that trading is a teachable skill, Dennis famously conducted the turtle trader experiment, proving that individuals with no prior trading experience could be taught a systematic approach to achieve remarkable success in the markets. He provided a clear set of rules, emphasizing that trading skills are not inborn, but can be acquired through structured learning and disciplined application. Imagine two individuals, Sarah and John. Sarah believes successful trading is a gamble, relying on gut feelings and news headlines. John, however, approaches it as a skill to be learned. He studies Dennis's principles, practices paper trading with a defined system, and gradually builds his understanding of market dynamics and his own reactions to them. Over time, John, through his dedicated learning, develops a more consistent and profitable trading approach than Sarah. Now let me share my personal experience with you. When I started trading like Sarah, even though I paid for an expensive mentorship program, I was still approaching trading as gambling. Oh well, this is probably a resistance level the price has gotten to. The price might probably move down here. Let me go for a short position to see what would happen, and if it works out well, I would be grateful and happy. As you probably know the results behind gambling and trading, it rarely works, because an asset chart or a currency pair reaches a resistance level does not necessarily move the price to the opposite direction. It only does that if it's aligned with many other factors, like market sentiment, market conditions, and also the overall trend. When I was in this gambling mindset, it was extremely difficult for me to understand market moves, and I was consistently accumulating massive losses till one day I shared my experience with my mentor, and afterwards I requested to have a live trading session with him, and when I did was given the chance, while we were going through analysis, anytime I was asked to express my thoughts about the market, or to make my own analysis to identify the next move probabilities in any specific market, I was just taking guesses. Like, well, I think the market may move from here to here probably. Wait, it might go to this place too. My mentor stopped me quickly and said something that changed my view about the market. He said, "The market doesn't follow guesses. If your goal is to guess and make money here, there's no way you're going to make it in this industry. By guessing, the markets follows key areas, and unless you learn to identify key areas in the markets and always be waiting for price rejections to occur at those key areas before you take action, you will always struggle with the market moves." This idea he gave me and the knowledge he shared with me about the market during our one-to-one live session trading changed my entire perspective of trading. What he shared with me was the crucial element in my trading results till today. Trading follows formulas like math. When you use these formulas properly and consistently to identify where to enter the market and when to exit, they work effectively. Gambling approach to trading is likely to lead you to terrible results or even massive losses, because I am a living proof that it doesn't work. Lesson number 2. Follow trends. One of the core tenets of Dennis's strategy was trend following. He emphasized identifying established trends in the market and riding them for as long as they persist. Trying to predict reversals or trade against the prevailing trend is often a recipe for losses. Suppose the price of crude oil has been steadily rising for several months, breaking through previous resistance levels. A trend follower, adhering to Dennis's principles, would look for opportunities to enter long positions, aligning themselves with the established upward momentum. They wouldn't try to short the market simply because they believe the price is too high. I don't know about you and your mental state, but what made me lose money like crazy, my early days in trading, is basically my idea of it's now at a resistance or it is now too high. Let me short it, without spending a lot of time to analyze charts, to know exactly if a trend is forming a continuation pattern to push higher or lower. Because according to my understanding that time, it is about the general rule, says buy low and sell high, and that was what I was trying to do, but in a wrong way. I will talk about charts patterns in one of our next videos. There's a lot in trading to learn than trying to make money using random strategies. To make sure you can be able to make money in trading, do not forget to subscribe so you can have the chance to learn everything necessary about trading through books, summaries, and world's best traders' experiences, and many other things like that. That is exactly what this channel is made for. Let's continue. Lesson number 3. Cut losses quickly when you know you are wrong. Protecting capital is paramount in trading. Dennis stressed the importance of having predefined stop-loss orders and adhering to them without hesitation when a trade moves against you. Small, controlled losses are a necessary cost of doing business. Large emotional losses can be devastating. For instance, not setting stop-loss when you take your positions or removing them whenever they market doesn't respond to your analysis is the only way you will never be able to have an idea about how much you're going to lose in a trade. Let's say you are risking 20 pips with your stop-loss. Now the chart is moving against you 15 pips, 18 pips, and then you remove the stop from your stop-out point. It basically means you are open to chase losses because it can go against you 50 pips, 100 pips, or even 200 pips. If you're still struggling to accept your losses when you predefined them, you'll always lose more than you can afford to lose in trading. The market has its own ways to make you suffer for your indiscipline. Now, if so, what do I need to do, right? Learn to accept small and controlled losses and always look for better opportunities in the market. If there is none, it's better you stay away. A trader who buys shares of a tech company at $100, placing a stop-loss order at $95. If the stock price unexpectedly drops to $94, a disciplined trader will automatically exit the position, limiting their loss to $5 per share. An undisciplined trader, hoping for a reversal, might hold on, only to see the price fall further to $80, incurring a much larger and more painful loss. Don't do that. That way is not for profitable traders. So avoid it and keep your drawdowns small in trading. Lesson 4. Let profits run. I really don't know how I can explain this concept to you better. Just as it's crucial to cut losses short, it's equally important to allow winning trades to realize their full potential. This requires patience and resisting the urge to take small profits prematurely out of fear of losing them. Trend following thrives on capturing substantial gains during strong market moves. If a trader enters a long position in a currency pair that is broken out of a consolidation phase, as the price continues to rise, they resist the temptation to take a quick profit. Instead, They use trailing stop to protect their gains while allowing the trade to continue running as long as the uptrend remains intact. This disciplined approach allows them to capture a much larger profit than if they had exited prematurely. Lesson number 5. Use a systematic approach. Dennis advocated for having a well-defined trading system with clear rules for entry, exit, position sizing, and risk management. This removes emotional decision-making and provides a consistent framework for navigating the markets. Instead of making trading decisions based on intuition or fleeting news, a trader using a systematic approach might have rules based on moving average crossovers, price breakouts, and volatility indicators. Every trade is executed based on these predefined criteria, ensuring consistency and allowing for objective evaluation of the system's performance over time. Number 6. Manage your risk effectively. I know you have heard the story of the man who managed risk in trading effectively to be able to trade a $400 account up to $200 million. Yeah, you probably know about that story, right? That person is Richard Dennis. He emphasized managing risk is not just a part of trading, it is trading. Proper position sizing, diversification when appropriate, and strict adherence to stop-loss orders are essential for long-term survival and profitability. The goal is to avoid any single trade that could significantly damage your capital. A trader with a $10,000 account who decides to risk no more than 1% of their capital on any single trade has a chance of placing 100 trades before making his profit, or losing his capital if all the 100 trade positions don't play in his favor, which is the worst-case scenario. Look at it this way. If you have $10,000 with a risk management rule of risking only 1%, that simply means that the potential loss on any of your given trade is $100. By consistently adhering to this rule, even a series of losing trades will not wipe out your account. Conversely, a trader who risks 20% of their capital on each trade could face ruin after just a few losses. Strict risk management can make you look like, "Ooh, no, I am not risking enough in my trading to make more money. Ooh, I should be capitalizing on these high probability setups," so on and so forth. Well, to make money, you need to learn how to survive in the market first. And once you learn that with a clean risk management rule, you will understand how easy it is to make money in trading. Lesson number 7. Discipline. Over emotion. The market can be a highly emotional environment, triggering fear, greed, and hope. Successful traders cultivate discipline, adhering to their trading plan regardless of these emotional impulses. They understand that consistent execution of their strategy is more important than reacting to every market fluctuation. During a period of market volatility, a trader's system generates a buy signal. Despite feeling anxious due to the recent price swings, a disciplined trader will execute the trade as per their rules. An emotional trader might hesitate or miss the entry opportunity due to fear, potentially missing out on a profitable move. If you're afraid to take a trade because of what happened to you in your previous trades, remember that each moment is different in the market. It's not because you lost 2 or 3 trades yesterday that you must lose the one that is present to you today. If the setup meets your criteria of entry, have the courage to enter no matter the outcomes of your past trades. Likewise, it's not because you have been winning constantly that you must be winning all the time. Each moment carries its randomness about the market. You might win or you might lose, and that is completely fine. Let's move to the 8th lesson. Lesson 8. Consistency is key. Consistent application of a sound trading strategy over the long term is far more important than trying to hit home runs with every trade. Small, consistent profits combined with controlled losses compound over time to generate substantial returns. A trader who consistently follows their system, taking all valid signals and adhering to their risk management rules, might achieve an average monthly return of 10%. While this might not seem spectacular in the short term, over several years, the compounding effect of these consistent gains can lead to significant wealth accumulation. So be focused and determined. Follow your strategies and risk management rules, and do it for a long period of time. Patience, persistence, and perspiration makes unbeatable combination for success, said Napoleon Hill. Lesson 9. Avoid overtrading at all cost. Experience has taught me that more trades don't lead to more profits. And as I have learned this lesson the hard way, I can tell you confidently from my own experience that the more you are trying to get involved in the market, the more elusive decisions and mistakes you'll make. The urge to there and be constantly in the market, driven by boredom or the fear of missing out opportunities, can lead to excessive trading and increased transaction costs and emotional fatigue. And Dennis advocated for patience and waiting for high probability setups that align with your trading system before getting involved in the market. A trader who feels compelled to trade every day, regardless of market conditions or the quality of available setups, is likely overtrading. They might take on marginal trades that don't meet their system's criteria, leading to increased losses and reduced profitability. A patient trader, on the other hand, waits for clear signals and only enters trades that have a higher probability of success. Lesson number 10. Continuous learning. The market is constantly evolving, and successful traders are lifelong learners. They continuously analyze their performance, identify areas for improvement, and stay updated on market dynamics and new trading techniques. When a trader keeps a detailed trading journal, recording every trade along with their reasoning and the outcome, it makes them realize the importance of learning continuously to improve their strategy, their risk management rules, and their trading psychology. Regularly reviewing this journal allows them to identify patterns in their winning and losing trades, understand their psychological tendencies, and refine their strategy over time. They also stay informed by reading market analysis, backtesting new ideas, and adapting their approach as market conditions change. By internalizing and consistently applying these 10 lessons you've just learned, inspired by the wisdom of Richard Dennis, traders can cultivate the psychological fortitude necessary to navigate the complexities of the market and significantly increase their chances of long-term success. Remember, mastering your own mind is the most crucial step in mastering the art of trading. Thank you so much for watching our videos. If you would like to help us grow this channel and help many other traders like you, please consider sharing the video with someone and subscribe if you are new here. Thank you.